Bim, what's up guys? Nick Masunda here, video number 22. I'm going to be talking about offset facilities and offset accounts and redraw facilities, why and how people use them. Why should you listen to me? I've been working in personal finance for about 7 years and just wanting to help share some of that knowledge so that you can make better decisions about your own personal finances. So before I get into the offset account versus redraw facility conversation, I want to talk about just the baseline understanding of pre-tax versus post-tax expenses, okay? Just to give that baseline before we jump into that. So I just want to talk about that for a few minutes. So firstly, we all earn an income. We have to pay some of that income to the ATO, and then we'll go out and use that income to make purchases, whether it's food, groceries, rent, mortgage, etc. Now, majority of these expenses are going to be post-tax expenses, meaning you will use dollars that you've already paid your income tax on to make the purchase. Okay. The ATO will allow you to use pre-tax dollars to purchase some items. Typically, these are items that are used to generate an income. Okay. So to illustrate why a pre-tax expense is more favorable than a post-tax expense, let's just look at a hypothetical item that you might want to buy. This item costs $70. All right. Oh, and I should mention, in this hypothetical, we're talking about someone who's within the marginal tax bracket of 30%. So they're earning somewhere between $45,000 and $135,000. So they're in the 30% marginal tax bracket, meaning every dollar they earn, 30 cents of that goes to the ATO. So this person wants to purchase a $70 item. With post-tax dollars, they actually have to earn $100 before they can pay for that $70 item, right? Because 30% of that $100 is paid to the ATO. Conversely, let's imagine that this is something that is critical for them to earn a living, and the ATO will allow it to be purchased with pre-tax dollars. That means they simply have to earn $70 in order to pay for that $70 item, right? Which means also that $30 that they had to pay in income tax when it was a post-tax item, that $30 they now get to keep after income tax. So 30% of $30 is $9. They end up with $21. So in this pre-tax example, they've got the item, the $70 item, but they've also got $21 in their pocket, extra dollars in their pocket. Whereas before, as in when it was a post-tax expense, they just had the item. Okay, so that hopefully illustrates the difference between a pre-tax and a post-tax expense and why we want to maximize our pre-tax expenses. Now, typically, employees will earn an income, their employer will preemptively pay their income tax on their behalf, and then they'll go out and make their purchases. So sometimes they're going to be buying things that they should be allowed to purchase as pre-tax expenses, but they're buying them with post-tax dollars. This is where the ATO will give you a tax deduction, and your accountant will reconcile this at the end of the financial year, and you would get a tax return. Okay, that's generally how that would work. But a tax deduction effectively means you're paying with pre-tax dollars. Right, now, when we talk about situations where someone's got a mortgage and they have some cash and they want to make the most of the cash and put themselves in the most favorable financial position, the advantages that come from these different facilities are often tax advantages. Okay, now these advantages are realized when you have a mortgage on your principal place of residence, because the interest payments on principal place of residence mortgage are post-tax expenses. Okay, if you have an investment property, these tax advantages from offset accounts, redraw facilities, they become null and void, all right? Because the interest on a mortgage interest for an investment property is already a pre-tax expense. Okay, so yes, this is in regards to your principal place of residence. So to illustrate the benefits here, I've broken the numbers down. We've got a couple of examples. So in this first scenario, we've got someone with a mortgage of $1 million. This person, again, they're in the 30% marginal tax bracket. So mortgage is $1 million, interest rate is 6%. That means their annual payments are $60K. This person also has $100,000 sitting in the bank account. Okay. Now, their bank has offered them a high interest savings account in this scenario, so they're getting a 5% interest rate on the $100,000 which they've deposited in this account. That equates to $5,000 a year. Now, they may be mistakenly thinking that their final position is simply the difference between $60,000 and $5,000. In other words, $55K, but that's not the case. And the reason that's not the case is because that $5,000 that they've earned in interest is taxable income. Okay, so they can only use pre-tax dollars to pay for this. They can only use post-tax dollars to pay for their mortgage on their principal place of residence. It's a post-tax expense. So they pay the interest rate at 30%. That equates to $1,500. And their final position is actually $56,500 using the high interest savings account. Second scenario, we're going to be looking at the offset account example. So it's the same situation. They've got $1 million mortgage, which they're paying 6%, but they've taken this $100,000 and they have now put it into an offset account. All right. First thing is, the interest rate is higher. It's the same interest rate as the mortgage. So just want to emphasize that there's already a benefit from having a higher interest rate. Okay. So they're earning $6,000 rather than $5,000 on the $100,000. Now that $6,000, because it's in an offset account, the ATO allows you to use that against your mortgage interest pre-tax. Basically, well, they effectively they allow you to use it pre-tax because they don't charge income tax on the earnings from an offset account. It completely offsets the mortgage, hence the name. So in this case, you don't have to pay the 30% on the income tax on the $6,000. So it's your final position is simply the difference between $60,000 and $6,000, which is $54K. Okay. So compared to the high interest savings account, you are $2,500 better off annually, which is obviously substantial in this example. A couple of things to consider here, which I haven't included for simplicity's sake: fees and change of rates. So some lenders will charge you a higher interest rate if you have an offset account with your loan. Not all lenders. There's definitely lenders that don't do this. Most lenders will charge fees, so you might be looking at $300, $400, $500 on an annual basis. Clearly, that's not going to offset the difference there of $2,500 completely, and it's still going to be worth it. But it may be worth engaging a mortgage broker just to make sure that they're finding you a lender that's going to be suitable, and the changes in rates and the additional fees don't mean that it's not going to be worth using the offset account at all. Okay, now redraw facility. This is the third scenario. This is effectively the same as the offset facility from a tax advantage point of view. Okay. Redraw facility is offered with majority of loans. The difference is convenience. So offset facilities are basically the same as like a transaction account. So you can deposit money, withdraw money just as easily. You can use a debit card with your offset account and make purchases just as easily. And you can use ATMs to access funds in the offset account. So It's very similar in terms of accessibility to a regular savings account or transaction account at the bank. With redraw facilities, the lenders often will limit how much you can redraw. So there's usually a minimum, and the frequency with which you can redraw. So it's definitely not as convenient to access the funds when you're dealing with a redraw facility. So that's one of the key differences between redraw facilities and offset accounts. That is, I think, most of what I wanted to cover off there, guys. So hopefully that was informative and helped clarify the pros and cons between high interest savings